My hope with anyone attending my presentation, especially Melanie, is that they walk away with this sense of empowerment that they now can go out and really understand what questions to ask and how to evaluate their portfolio. So what I'm going to do right now is show you what modern portfolio theory is all about.
I'm trying to understand what is your operational definition of a portfolio. Because when I think of a portfolio, I think of the stocks, the bonds, the money market.
And it's an excellent question, Melanie. Some people want to include their house. Some people want to include their private investments.
Right.
Okay? And everyone's going to look at their portfolio and interpret it a little differently.
I always considered my portfolio as investments being stocks and bonds and money market. Now I know to look at my portfolio as the whole picture of all the assets, what I have in my business, what I have in my home, and what I have in terms of financial investments.
One of the concepts that I really focus in on is the Sharpe ratio. Now, William Sharpe, who won the Nobel Prize, will say there's some issues with the Sharpe ratio. Well, it's not perfect, but it definitely gives you an understanding of how to measure risk in a portfolio. Sharpe is simply taking your historical rate of return and subtracting your risk-free rate of return and dividing it by your standard deviation. So let me go through each component because it's very easy and all that information is available to you. Your historical rate of return, all right, easy to get. This risk-free, all right, anytime I see anything that looks like that, I get scared, okay? But what it really is your money market. It's any investment which is like your 30-day treasury bill, anything that is very short-term, that is very liquid, and you can use money market. And you want to evaluate it over a 10-year period. So the number you put here for money market shouldn't be what money market is today, it should be what it is over that 10-year time horizon. And you simply divide it by your standard deviation, which is the volatility. All of these numbers are readily available for you. You want your standard deviation to be 60% or less than your historical rate of return. Now let's fill it in. Let's say that this was a rate of return of 10. I'm going to use just some round numbers. I'm not suggesting this is anybody's portfolio. And let's say money market, to keep it easy, was 5. And you had a standard deviation of 15. That would mean that the Sharpe ratio on that particular portfolio was 0.33. Your standard deviation should be 60% or less than your historical rate of return. Your Sharpe ratio, if it's close to 1, that's good. But if you have a Sharpe ratio that's below 0.3, you're taking too much risk for the expected return. And your fees, you want to get them as low as possible. I generally believe that you should not pay more than 50 to 75 basis points to have your money managed. Thank you very much for coming tonight. I simply wanted to share some of these facts with you, a way for you to evaluate the risk in your portfolio and really take more control of what you're doing. And the way you can do that is with more knowledge.
Ed's seminar was a really eye-opening experience. As I was sitting in the seminar, I was thinking to myself how much more research I could do on some of the investments that I currently have to evaluate them based on some of the criteria that Ed gave me tonight. Some of the information that he presented was just a real aha moment for me.